We've got breaking news. Uber pricing its IPO just moments ago.
A number of analysts ahead of this IPO today have come out.
This is an IPO. The IPO window is opening.
One three-letter word has been taking Wall Street by storm lately: IPO. It stands for Initial Public Offering, which takes place when a company allows anyone and everyone to trade its shares for the first time. This year, we've seen names you've probably heard of, names like Uber, Lyft, Pinterest, and Chewy. The IPO volume has been soaring this year, which is why IPOs have gotten so much attention these days. Recent IPOs are also performing well. 14 companies have surged 50% or more on their first day of trading, and an index that represents recent IPO returns is up more than double that of the broader stock market this year. So that's bringing even more investors to the table looking to make a quick buck. Now, some IPOs have faltered, however. Uber and Lyft are each trading below the price at which they went public, and some consumers are concerned it may mean they're paying higher prices for products and services, as public companies tend to focus a bit more on profitability than private ones. But you may want to get used to it. More and more companies are expected to go public in the coming months. Peloton, Postmates, The RealReal have all started the process. Airbnb is also flirting with the idea, although may not make any moves until next year. Slack is going public via something similar to an IPO, but different. It's called a direct listing. Slack is only the second large company to try a direct listing after Spotify did one last year. A direct listing is a new twist on the more traditional IPO process. It involves a lighter touch from Wall Street banks and more of an auction-like method to find the price. Here are some of the key ways direct listings are shaking things up in the IPO world.
A direct listing differs from the more traditional initial public offering in three major ways. One, no underwriters. In an IPO, underwriters will find investors, market the shares, and help set a price based on demand. Direct listings instead involve financial advisors, usually from the same Wall Street firms. These bankers provide advice about the process and help with the discovery of the opening price. Financial advisors cost less than underwriters. Spotify's direct listing cost about a third of what the company would have spent on an IPO, saving the company about $100 million. Two, no cash. Instead of raising money, the primary purpose of a direct listing is to create a public market for a stock by allowing early investors and employees to sell and newer investors to buy. Three, no roadshow. Traditional IPOs require executives to spend 2 weeks on the road, visiting with investors to pitch the deal and drum up demand. But direct listings generally require just 1 day, really just a few hours, for executives to webcast the pitch for any investor who wants to tune in.
Hey, NBC News fans, thanks for checking out our YouTube channel. Subscribe by clicking on that button down here and click on any of the videos over here to watch the latest interviews, show highlights, and digital exclusives. Thanks for watching.